Analyst report. The impact of a renewed sovereignty push by Xi Jinping over Taiwan. Implications for 10 major global companies. Executive summary. As President Xi Jinping intensifies his sovereignty claims over Taiwan, especially in direct talks with President Trump, the global business landscape faces a profound recalibration. This report delivers a comprehensive, sector-by-sector and company-by-company analysis of how such a geopolitical shift could impact 10 major corporations with significant exposure to the Taiwan-China dynamic. The companies are divided into those with bearish exposure, TSMC, Apple, Boeing, Nvidia, Starbucks, and those with bullish exposure, Lockheed Martin, Raytheon, Northrop Grumman, ASML, Occidental Petroleum. The analysis integrates macroeconomic, regulatory, supply chain, and investor sentiment perspectives, drawing on the latest developments, historical precedents, and scenario-based stress testing. A summary table at the end of this report compares all 10 companies by sector, risk exposure, and potential upside/downside, providing actionable insights for investors and corporate strategists. Macro geopolitical scenario. Xi Jinping's renewed sovereignty push and U.S.-China dynamics. The recent direct talks between President Xi Jinping and President Trump have brought the Taiwan issue to the forefront of global geopolitics. Xi's insistence on Taiwan's return as an integral part of the post-war international order has been met with firm resistance from Taiwan's government and cautious ambiguity from the U.S., which opposes the use of force but maintains strategic ambiguity regarding military intervention. The situation is further complicated by Japan's explicit warning that any military action against Taiwan would trigger a forceful response, and by the U.S. and China's recent trade truce, which has temporarily eased some economic tensions but left underlying strategic rivalries unresolved. The macroeconomic implications of a Taiwan contingency are profound. A conflict or even a severe escalation would disrupt global supply chains, particularly in semiconductors, electronics, and advanced manufacturing, and could trigger a flight to safety in financial markets, commodity price shocks, and a reordering of global trade alliances. The U.S. and its allies have already begun to friendshore critical supply chains, while China has leveraged its dominance in rare earths and critical materials as a strategic counterweight. Sectoral analysis, risk exposure, and strategic dynamics. 1. Semiconductors and advanced technology. Taiwan's Semiconductor Manufacturing Company, TSMC, TSM, direct and indirect exposure. TSMC is the world's largest contract chip maker, producing over 60% of global semiconductors and 90% plus of advanced chips, 7 nanometers and below, serving clients such as Apple, Nvidia, AMD, and Qualcomm. Its main fabs are concentrated in Taiwan, making it the single most critical node in the global technology supply chain. Supply chain vulnerabilities. TSMC's geographic concentration in Taiwan is its greatest vulnerability. Over 90% of its wafer capacity remains on the island, and advanced packaging, CoWoS, is also Taiwan-centric. While TSMC is investing over $165 billion in U.S., Arizona, Japan, and Germany fabs, these facilities are years away from matching the scale and sophistication of its Taiwan operations. Any disruption, whether from military conflict, blockade, or cyber attack, could halt global production of advanced chips, crippling industries from AI to automotive. Regulatory, trade, and military catalysts. TSMC is caught between U.S. export controls, which restrict advanced chip sales to China, and Chinese pressure to prevent hollowing out of Taiwan's chip industry. The U.S. has threatened tariffs of up to 100% on imported semiconductors to incentivize domestic production, though implementation has been delayed to avoid provoking China. China, meanwhile, has used rare earth export controls and diplomatic pressure to influence TSMC's global expansion. Historical performance. TSMC's stock and the broader Taiwan market have historically been highly sensitive to cross-strait tensions, with sharp sell-offs during crises, but rapid recoveries when stability returns. The silicon shield concept, Taiwan's centrality to global chips as a deterrent, remains a double-edged sword. Strategic positioning and investor sentiment. TSMC is accelerating overseas expansion, but its most advanced R&D and production remain in Taiwan by government mandate. Investor sentiment is bullish on AI-driven demand, but geopolitical risk is increasingly priced in evaluations, with some hedge funds taking contrarian positions, e.g., long Intel, short TSMC. Summary: TSMC faces the highest direct risk from a Taiwan contingency, with catastrophic downside in a worst-case scenario, but continued dominance if stability holds. Its global expansion offers some mitigation, but the world remains deeply dependent on its Taiwan fabs. NVIDIA, direct and indirect exposure. NVIDIA is the world's leading designer of AI and graphics chips, with 100% of its most advanced GPUs, H100, H200 Blackwell, fabricated by TSMC in Taiwan. Its dependence on TSMC is more acute than that of most peers, as Samsung and Intel lag in advanced node yields and packaging. Supply chain vulnerabilities. A disruption at TSMC would instantly halt NVIDIA's ability to supply AI accelerators, with no viable second source until at least 2027. Advanced packaging, CoS, is also concentrated in Taiwan, compounding the risk. Regulatory, trade, and military catalysts. U.S. export controls have already restricted NVIDIA's ability to sell high-end AI chips to China, forcing the company to develop China-only variants, 800, H800, that are now also banned. Any escalation could further limit NVIDIA's addressable market and supply chain flexibility. Historical performance. NVIDIA's stock has soared on AI demand, but analysts warn that the market is underpricing the single point of failure, risk in Taiwan. In past crises, NVIDIA has experienced sharp drawdowns, but has rebounded on strong fundamentals. Strategic positioning and investor sentiment. NVIDIA is investing in supply chain diversification, e.g., supporting Intel's foundry ambitions, but remains years away from meaningful second-source capacity. Investor sentiment is bullish, but increasingly cautious, with some funds hedging exposure via puts or short positions. Summary: NVIDIA's upside is tied to AI growth, but its downside risk is extreme in a Taiwan crisis. The company is the poster child for the global TSMC risk. ASML, direct and indirect exposure. ASML is the sole supplier of extreme ultraviolet, EUV, lithography machines, essential for advanced chip production at TSMC, Samsung, and Intel. While not directly exposed to Taiwan, its fortunes are intertwined with the global semiconductor cycle and export control regimes. Supply chain vulnerabilities. ASML's technology is irreplaceable. China has spent $41 billion trying and failing to replicate EUV capabilities. U.S. and Dutch export controls have blocked sales of EUV, and now some DUV, systems to China, limiting ASML's addressable market, but protecting its technological edge. Regulatory, trade, and military catalysts. Recent U.S. and Dutch rules have tightened restrictions on ASML's exports to China, but the company expects the impact to be manageable within its 2025 outlook. Long-term demand for advanced lithography remains robust, driven by AI, automotive, and defense applications. Historical performance. ASML has outperformed on the back of secular chip demand, but its stock is sensitive to swings in the China market and global trade policy. Strategic positioning and investor sentiment. ASML is viewed as a picks and shovels play on the global chip build-out, with strong pricing power and order visibility. Investor sentiment is positive, with some caution around export control risks. Summary: ASML is a relative winner from global chip reshoring and defense spending, with moderate downside from China exposure, but strong long-term tailwinds. Apple, APL, direct and indirect exposure. Apple is TSMC's largest customer, with all advanced iPhone, iPad, and Mac processors fabricated in Taiwan. Its supply chain is deeply integrated with both Taiwan for chips, PCBs, optics, and China for assembly and many components. Supply chain vulnerabilities. Apple has begun diversifying assembly to India and Vietnam, but high-value components, chips, displays, optics, remain Taiwan-centric. A disruption in Taiwan would halt iPhone production, while a conflict with China could block access to its second-largest market and key suppliers. Regulatory, trade, and military catalysts. Apple faces risk from both U.S. and Chinese policy. The Trump administration has threatened tariffs on imported electronics and pressured Apple to increase U.S. manufacturing, while China could retaliate against Apple in a crisis. Apple's market access in China is vulnerable to consumer boycotts and regulatory action. Historical performance. Apple's stock has weathered past trade wars and supply chain shocks, but remains highly sensitive to China-Taiwan developments. Strategic positioning and investor sentiment. Apple is accelerating supply chain diversification, investing in U.S. and India manufacturing, and deepening ties with Taiwanese suppliers. Investor sentiment is cautious but constructive, with a focus on Apple's resilience and brand strength. Summary. Apple faces high downside risk from a Taiwan or China crisis, but its global brand and diversification efforts offer some mitigation. The company is a bellwether for global supply chain resilience. 2. Aerospace and commercial aviation. Boeing BA. Direct and indirect exposure. Boeing's exposure to Taiwan-China tensions is primarily through its commercial aircraft business, which has historically relied on China as a major customer. The company also has a defense segment, but its Taiwan exposure is limited compared to Lockheed Martin or Raytheon. Supply chain vulnerabilities. Boeing's supply chain is global, with some components sourced from China and Taiwan. However, its main risk is demand side. Chinese tariffs and retaliatory measures have already frozen Boeing's ability to deliver planes to China, forcing the company to redirect inventory to other markets. Regulatory, trade, and military catalysts. The U.S.-China trade war has resulted in tit-for-tat tariffs, 145% on Chinese goods, 125% on U.S. goods, directly impacting Boeing's sales pipeline in China. Any escalation over Taiwan could lead to further sanctions, loss of market access, or even expropriation risks. Historical performance. Boeing's stock has been volatile, with sharp drawdowns during trade disputes and the COVID-19 pandemic, but has shown resilience through strategic market shifts and global diversification. Strategic positioning and investor sentiment. Boeing is actively diversifying its customer base, focusing on Europe, the Middle East, and Latin America, and leveraging its defense business for stability. Investor sentiment is cautious, with a focus on supply chain resilience and global demand recovery. Summary. Boeing faces moderate downside from a Taiwan crisis, primarily through lost China sales and potential supply chain disruptions. Its global diversification and defense exposure offer some mitigation. 3. Consumer and retail. Starbucks, SBUX. Direct and indirect exposure. Starbucks' second-largest market is China, where it operates thousands of stores. While not directly exposed to Taiwan, the company is vulnerable to shifts in Chinese consumer sentiment and regulatory risk in a crisis. Supply chain vulnerabilities. Starbucks sources some ingredients and packaging from China and the broader region, but its main risk is demand side. A consumer boycott or regulatory crackdown could sharply reduce sales. Regulatory, trade, and military catalysts. Starbucks has faced increasing competition from local brands, e.g., Luckin Coffee, and price wars, as well as economic headwinds from China's slowing growth. In a Taiwan crisis, Starbucks could become a symbolic target for nationalist backlash. Historical performance. Starbucks' China sales have been volatile, with recent declines offset by a surprise rebound in Q3 2025 following price cuts and operational reforms. The company's stock is sensitive to China news flow. Strategic positioning and investor sentiment. Starbucks is investing in product innovation, operational efficiency, and local partnerships to regain momentum in China. Investor sentiment is mixed, with some optimism about a turnaround, but caution about geopolitical risk. Summary. Starbucks faces moderate downside from a Taiwan crisis, primarily through demand shocks in China. Its global brand and operational agility offer some resilience. 4. Defense and aerospace. Lockheed Martin, LMT, Raytheon, RTX, Northrop Grumman, and OC. Direct and indirect exposure. These U.S. defense primes are major suppliers of arms and systems to Taiwan and U.S. allies in the Indo-Pacific. Lockheed Martin is the lead contractor for F-16 fighters and missile systems. Raytheon supplies air defense and radar. Northrop Grumman provides ISR and advanced systems. Supply chain vulnerabilities. While these companies have global supply chains, their exposure to China is limited by export controls and national security regulations. However, they face risks from Chinese sanctions, cyber attacks, and potential supply chain disruptions for critical materials, e.g., rare earths, regulatory, trade, and military catalysts. China has sanctioned most leading U.S. defense firms over arms sales to Taiwan, freezing assets and banning trade with Chinese entities. However, these sanctions have limited practical impact, as the company's main markets are the U.S. and allies. U.S. defense spending is rising, with bipartisan support for increased aid to Taiwan and Indo-Pacific allies. Historical performance. Defense stocks have historically outperformed during periods of geopolitical tension, benefiting from increased military spending and arms sales. Strategic positioning and investor sentiment. Lockheed Martin, Raytheon, and Northrop Grumman are well positioned to benefit from a Taiwan crisis, with strong order books, technological leadership, and government support. Investor sentiment is bullish, with a focus on long-term growth and cash flow. Summary. U.S. defense primes are clear beneficiaries of rising Taiwan tensions, with upside from increased arms sales, military aid, and strategic demand. 5. Energy and commodities. Occidental Petroleum, OXY. Direct and indirect exposure. Occidental Petroleum is a major U.S. oil and gas producer with global operations. Its direct exposure to Taiwan or China is limited, but it is highly sensitive to global energy market dynamics. Supply chain vulnerabilities. A Taiwan crisis would trigger a global energy shock, disrupting seaborne oil and LNG flows to East Asia, China, Japan, South Korea, and potentially leading to price spikes and supply chain disruptions. Occidental could benefit from higher prices and increased demand from U.S. allies seeking to diversify away from Russian and Middle Eastern supplies. Regulatory, trade, and military catalysts. Western sanctions on China in a conflict scenario could reshape global energy flows, with the U.S. and allies redirecting exports to Japan and South Korea, and China relying more on Russia. Insurance and shipping risks would rise, but Occidental's U.S. base offers relative insulation. Historical performance. Energy stocks have historically outperformed during geopolitical crises that disrupt supply, though volatility can be extreme. Strategic positioning and investor sentiment. Occidental is investing in low-carbon technologies and expanding its U.S. production base. Investor sentiment is constructive, with a focus on cash flow and exposure to price upside. Summary. Occidental Petroleum stands to benefit from energy market disruptions in a Taiwan crisis, with upside from higher prices and demand shifts. Cross-sector supply chain vulnerabilities and friendshoring trends. The Taiwan-China crisis has accelerated global efforts to de-risk and friendshore critical supply chains. The semiconductor sector is at the epicenter, with the U.S., EU, and Japan investing hundreds of billions in domestic chip manufacturing and advanced packaging. However, replicating Taiwan's scale and expertise will take years, and the world remains deeply dependent on TSMC and its ecosystem. Other sectors, from aerospace to consumer electronics, are also diversifying suppliers and building inventory buffers. Companies are conducting scenario-based stress tests, investing in business continuity planning, and seeking insurance against geopolitical shocks. However, the complexity and cost of these efforts are significant, and the risk of just-in-case inefficiencies is rising. Legal, regulatory, and export control risks. The U.S. and its allies have tightened export controls on advanced semiconductors, AI chips, and manufacturing equipment, targeting China's military civil fusion strategy. These controls have forced companies like TSMC, NVIDIA, and ASML to navigate a complex web of compliance, with significant penalties for violations. China has responded with its own export controls on rare earths and critical materials, as well as sanctions on U.S. defense firms. The Trump administration's tariff policy remains fluid, with threats of 100% tariffs on imported semiconductors and electronics. But implementation has been delayed to avoid provoking China and raising consumer prices. Companies are lobbying for exemptions and accelerating U.S. investments to mitigate risk. Historical market reactions and investor sentiment. Past geopolitical escalations, e.g., 1996 Taiwan Strait Crisis, 2018 to 2019 U.S.-China trade war, 2022 Ukraine war, have triggered sharp market sell-offs, flight to safety, and sector rotations. Semiconductor and tech stocks are particularly sensitive, with high volatility and rapid recoveries when stability returns. Defense and energy stocks have historically outperformed during crises. Institutional investors are increasingly hedging exposure to Taiwan and China, reallocating to defense, energy, and friendshoring beneficiaries. ETF flows reflect this rotation, with semiconductor ETFs facing tariff headwinds and defense ETFs attracting inflows. Scenario analysis and stress testing. Best case scenario. Tensions remain high but contained. Trade truce holds. Companies accelerate diversification but avoid major disruptions. Semiconductor and tech stocks remain volatile but recover on strong fundamentals. Defense and energy stocks outperform on increased spending and price shocks. Worst case scenario. Military conflict or blockade disrupts Taiwan's chip production. Global supply chains freeze. Tech stocks crash. Defense and energy stocks surge. Global recession risk rises, with inflation and commodity price spikes. Most likely scenario, short-term. Continued gray zone coercion, cyber attacks, and diplomatic pressure. Episodic market volatility. Gradual supply chain diversification. Selective winners and losers by sector and company. Comparative risk, reward summary table. Conclusion, actionable insights, and strategic recommendations. The renewed sovereignty push by Xi Jinping over Taiwan, especially in direct talks with President Trump, has elevated geopolitical risk across global markets. The 10 companies analyzed in this report face divergent risk-reward profiles, shaped by their sector, supply chain exposure, and strategic positioning. TSMC and NVIDIA are the most exposed to a Taiwan crisis, with existential downside but continued dominance if stability holds. Their global expansion efforts offer some mitigation, but the world remains deeply dependent on Taiwan's chip ecosystem. Apple faces high supply chain and market access risk, but its brand strength and diversification efforts provide resilience. Boeing and Starbucks face moderate downside from lost China sales and demand shocks, but global diversification offers some buffer. Lockheed Martin, Raytheon, and Northrop Grumman are clear beneficiaries of rising defense, spending, and strategic demand, with limited downside from Chinese sanctions. ASML stands to benefit from global chip reshoring and defense demand, with moderate risk from export controls. Occidental Petroleum is positioned to gain from energy market disruptions, with upside from higher prices and demand shifts. Strategic recommendations. Investors should hedge exposure to Taiwan-centric supply chains, overweight defense and energy, and monitor policy developments closely. Companies must accelerate supply chain diversification, invest in business continuity planning, and engage proactively with policymakers to manage regulatory risk. Scenario-based stress testing and contingency planning are essential for resilience in an increasingly volatile geopolitical environment. The Taiwan question is now the central axis of global economic and security risk. The companies best positioned for the future will be those that combine technological leadership with supply chain agility, geopolitical foresight, and strategic resilience. That's all for now. Feel free to check out our sponsored snack section below. Best wishes to all, happy Thanksgiving and a profitable trading week.